It's 2:47 in the morning, and Sarah is sitting at her kitchen table, in the dark, lit only by the glow of her laptop screen, staring at a number that doesn't make any sense. 5 years. 5 years of doing everything she was told to do. Pack her lunch. Skip the daily coffee run. Put 20% of every paycheck straight into savings before she lets herself spend a dime on anything fun. 5 years of telling herself no, so that future Sarah could say yes. And when she opens her banking app that night, after a conversation with a coworker who casually mentioned they'd made more from one stock than from 2 years of salary, Sarah does the math on her own accounts for the first time in longer than she'd like to admit. Her savings balance has grown, barely, slower than her rent, slower than her grocery bill, slower, if she's honest with herself, than the pace at which her own hope is draining out of her. She sits back in her chair and whispers the sentence that will end up changing the entire direction of her financial life. I did everything right, and I'm still stuck. That moment, that exact feeling of doing everything the way you were taught and still watching the finish line move further away, is where this story really begins. But to understand how Sarah got to that kitchen table, and more importantly, how she got up from it and built something real, we have to rewind the clock a little further. Let's go back about 5 years, to a version of Sarah who is 26 years old, freshly settled into a stable job, and proud, genuinely proud, of the fact that she is not like some of her friends. She isn't swiping her credit card without thinking. She isn't living paycheck to paycheck. She read the articles, she watched the videos, she built a budget in a spreadsheet with color-coded tabs, and the advice she absorbed from almost every source she trusted said the same thing over and over, like a mantra: save your money, build an emergency fund, put it away, and don't touch it. So that's exactly what she did. Every 2 weeks, a chunk of her paycheck moved automatically into a savings account, and every 2 weeks, Sarah felt a small glow of pride watching that number tick upward. She wasn't reckless, she wasn't foolish, she was, by every measure she'd been given, doing it right. And here's the part that deserves a moment of real honesty, because so many people are living exactly this chapter of Sarah's story right now. Maybe even you. There is nothing wrong with what Sarah did. Saving money is not a mistake. It is a discipline, and discipline is rare, and it deserves respect. The problem was never that Sarah saved. The problem was that no one ever explained to her the difference between two things that sound almost identical but behave completely differently over time: storing money and growing money. That distinction, the one nobody sat her down and explained, is the entire hinge this story swings on. Saving money is like putting your groceries in the refrigerator. It keeps what you have from spoiling too quickly, but it doesn't make more groceries appear. Investing, on the other hand, is like planting a garden with those same groceries. Some of what you plant takes root, spreads, and multiplies so that a single seed eventually produces far more than you put into the ground. Sarah had spent 5 years diligently refrigerating her money. She had never once planted any of it. Before we go any further into how Sarah figured this out and what she actually did about it, if this idea is already landing for you, if you're sitting there realizing you might be refrigerating your own money too, that's exactly the kind of moment worth remembering. A quick like on this video helps it reach other people who are stuck in that same refrigerator. And subscribing means you won't miss the rest of what Sarah learned, because the next part is where things get genuinely useful. Alright, let's get back to her story. The coworker who made the comment about stocks was named Priya, and she worked 2 desks down from Sarah in the same open plan office. Priya wasn't flashy. She drove a modest car, wore the same handful of blazers on rotation, and packed her lunch just like Sarah did. Which is exactly why her comment hit so hard. If Priya had been some trust fund kid throwing around numbers, Sarah could have dismissed it. But Priya was ordinary in every visible way, and yet she'd apparently built something Sarah hadn't even known was possible for someone like them. So the next day, nursing a coffee at her desk instead of running from meeting to meeting, Sarah finally asked her directly. Priya's answer wasn't a secret formula or an insider tip. It was a single question that she turned back on Sarah. Do you know what your money is actually doing for you right now? Sarah blinked. She knew where her money was. She knew the interest rate on her savings account, technically, though she'd never really thought about what that number meant in practice. Priya asked her to pull it up. Sarah's savings account was earning a small fraction of a percent annually, so small that on her balance, it amounted to a few dollars a month. A few dollars, after 5 years of disciplined saving. Priya then asked a second question that Sarah has repeated to herself almost every day since. If your money isn't working while you sleep, who exactly is doing all the work in this relationship? That single sentence cracked something open in Sarah's thinking, because up until that point she had always framed money in terms of her own effort. She worked, she earned, she saved, she restrained herself from spending. The entire system revolved around her labor and her discipline. But Priya was describing something different. A system where money itself goes out and generates more money, independent of how many hours Sarah personally puts in. That's the concept of an asset, in the truest financial sense. Not just something you own, but something that produces income or grows in value on its own, even while you're asleep, even while you're on vacation, even while you're doing literally anything else with your time. This is where Priya introduced Sarah, and now you, to a distinction that quietly separates people who feel stuck from people who build wealth over time. The difference between depreciating assets and income-generating assets. A depreciating asset is something that loses value the moment you acquire it, and keeps losing value the longer you hold it. Think about a car. The instant you drive a new car off the lot, it's worth measurably less than what you paid. Every year that follows, it loses more. It might serve you well, it might be genuinely useful, but financially speaking, it is bleeding value the entire time you own it. An income-generating asset works in the opposite direction. Think about a small rental property, a share of a profitable company, or a fund made up of many companies. These don't just sit there. They can produce dividends, rental income, or long-term appreciation, meaning the asset itself is quietly working to create more value over time, often without you lifting a finger after the initial decision to buy in. Sarah's entire financial life up to that point had been built around avoiding the first category. She hadn't bought a flashy car. She hadn't run up credit card debt on things that lose value the second she owns them. And that discipline mattered. But nobody had ever pointed her toward the second category. Nobody had shown her that there was a whole second half of the financial world where instead of just protecting what you have from loss, you actually put it to work so it can grow into something larger. Her savings account, technically, was not even really doing the storing job well, because inflation, the gradual rise in the cost of everyday goods, was quietly eating away at the purchasing power of her saved dollars faster than her tiny interest rate could replace it. She wasn't just standing still. In real terms, adjusted for the rising cost of living, she was slowly moving backward. That night, the same night as that conversation with Priya, is actually not the moment we opened on. That comes a little later, but this was the spark. Sarah went home and for the first time, typed a phrase into a search bar that would change the trajectory of her financial education. How does investing actually work for beginners? And one of the very first concepts she stumbled across is one worth explaining clearly right now, because it might be the single most important piece of financial math most people never learn in school, the Rule of 72. Here's how it works. The Rule of 72 is a simple shortcut that tells you approximately how many years it will take for your money to double, based on a fixed annual rate of return. You simply take the number 72 and divide it by the interest rate you're earning. So if you're earning, say, a 6% average annual return, you divide 72 by 6 and you get 12. That means at a steady 6% return, your money would roughly double every 12 years. Compare that to Sarah's actual savings account, earning a fraction of 1%. Divide 72 by a number that small, and you get a doubling time measured not in decades, but in centuries. That's the gap Sarah had been living inside without realizing it. It wasn't that she was failing at saving, it was that she was playing an entirely different game than the one that actually builds wealth, and the rules of that other game meant her money was doubling on a timeline longer than a human lifetime. Now here's where the story gets interesting, because understanding the Rule of 72 intellectually is one thing, but actually acting on it is another. And this is where most people, Sarah included at first, hit their biggest obstacle. It wasn't a lack of information anymore. It was fear. Specifically, the fear of watching her money go up and down. Because unlike her savings account, which just sat there, quiet and predictable, an investment account moves. Some days it's up, some days it's down. And for someone who had spent 5 years finding comfort in a number that only ever climbed, even slowly, the idea of watching that number occasionally drop felt less like investing and more like gambling. This fear has a name in financial psychology, and it's worth understanding because it affects nearly everyone who has ever tried to build wealth. It's called loss aversion. Human beings are wired psychologically to feel the pain of losing something roughly twice as intensely as we feel the pleasure of gaining the same amount. Losing $100 stings far more than finding $100 feels good. So when Sarah imagined watching her hard-earned money dip in value, even temporarily, even as part of a completely normal market fluctuation, her instincts screamed at her to avoid that feeling entirely by staying in the safety of her savings account. But here's the reframe that helped her move past it. One that might help you too. A temporary dip in an investment's value is only a real loss if you panic and sell during that dip. If you leave the money invested and give it time, temporary drops are simply part of the process. The same way a garden doesn't grow in a perfectly smooth, uninterrupted line. Some seasons are lean, some are stormy, but a garden tended over years produces far more than a single perfect afternoon ever could. Let's sit with the rule of 72 for one more moment, because there's a thought experiment that makes its power impossible to ignore, and it's one Sarah herself ran into a few days after that late-night search. Picture two friends. We'll call them Friend A and Friend B. Friend A starts investing at age 25, putting in a modest amount and then stopping entirely after just 10 years, letting whatever has accumulated simply sit and grow, untouched, for the next 30 years. Friend B waits, gets busy with life, and doesn't start investing until age 35, but then contributes that same modest amount every single year for the next 30 years straight, working far harder and contributing far more money overall than Friend A ever did. Here's the part that surprises almost everyone the first time they see it. Assuming a similar average rate of return, Friend A, who invested for only 10 years and then walked away, often ends up with more money at retirement than Friend B, who invested diligently for 3 times as long. The difference isn't effort. It isn't even total dollars contributed. It's time. Time is the one ingredient in compound growth that money itself cannot buy back once it's gone. This is exactly why Sarah's late realization stung so much, but it's also exactly why she stopped wasting any more of it once she understood what was at stake. Every month spent purely refrigerating money instead of planting it is a month of potential growth that can never be recovered, no matter how much is contributed later to make up for it. That thought experiment did something important for Sarah beyond just motivating her. It reframed the $500 she was about to invest. It wasn't just $500, it was $500 plus every year of growth that number would have ahead of it, compounding quietly, year after year, long after she'd forgotten the exact moment she pressed the button. Suddenly the amount mattered less than the starting point. Beginning small today, she realized, would almost certainly outperform beginning large sometime later, simply because of how many years that money would have to work in the background of her life. Sarah started small. Actually, she started with exactly $500. Money she'd already set aside in her emergency fund cushion. Money she decided she could afford to let work for her instead of just sit for her. And this is the part of the story worth pausing on, because so many people assume you need thousands of dollars, some special connection, or insider knowledge to begin investing. You don't. Sarah's first move wasn't dramatic. She didn't quit her job. She didn't bet everything on a single hot stock tip from a stranger online. She opened a simple brokerage account and put that $500 into a broad, diversified fund, essentially a single purchase that gave her a small sliver of ownership across hundreds of different companies at once, rather than betting everything on the fortunes of just one. That word, diversified, deserves a real explanation, because it's the concept that turns investing from a nerve-wracking gamble into a manageable, long-term strategy. Imagine if Sarah had instead taken her $500 and put all of it into a single company's stock. If that one company had a phenomenal year, she'd do great. But if that company had a scandal, a product failure, or simply fell out of favor, her entire $500 would feel that impact directly and painfully. Diversification means spreading that same $500 across many companies, many industries, sometimes even many countries, so that no single piece of bad news can sink the whole ship. If one company in that basket struggles, others might be thriving, smoothing out the ride considerably. It's the financial equivalent of not putting all your eggs in one basket, except here, the eggs are dollars, and the basket is your entire financial future. This is roughly the point in the story where we arrive back at that kitchen table. The 2:47 a.m. scene from the very beginning. Except now, you have all the context needed to feel exactly what Sarah was feeling in that moment. Remember, this was the night after her conversation with Priya, after she'd gone home and researched the rule of 72. After the numbers had made the gap between saving and investing painfully, undeniably clear. She's sitting there in the dark, laptop open, staring at 5 years of disciplined saving that had grown slower than her own rent. And in that moment, the frustration she feels isn't really about the small dollar amount on the screen. It's about something deeper. The quiet fear that she had been doing everything right by the rules she was handed, and it still wasn't going to be enough. That's the moment so many people reach and never move past. They see the gap, feel the sting of it, and either freeze in place out of fear or numbly go back to the same habits, because at least those habits feel familiar and safe. But Sarah did something different that night. Instead of closing the laptop and going to bed defeated, she opened a new tab, searched for a reputable, low-cost brokerage platform, and began the account setup process right then and there. Fingers moving across the keyboard at nearly 3 a.m, driven by a mixture of frustration and something new, a flicker of hope that there might actually be a way out of the pattern she'd been stuck in. It took her about 20 minutes to get the account open. It took her considerably longer, almost 2 more weeks, to actually transfer that first $500 in and click the button to invest it. Because knowing something intellectually and acting on it emotionally are 2 very different thresholds to cross. And Sarah's hand hovered over that final confirmation button more than once before she finally pressed it. When she did, nothing dramatic happened. No fireworks, no instant windfall, just a simple confirmation screen and a new number and a new account. But that quiet, undramatic click was the actual turning point of this entire story, because it marked the moment Sarah stopped being a passive saver and became, for the first time in her adult life, an active builder. Over the following months, Sarah didn't check that account obsessively, though in the early days, she'll admit she peeked more often than she probably should have. She watched it dip during a rocky week in the broader market and felt that familiar tightness in her chest, the loss aversion instinct kicking in exactly as the psychology predicted it would. But she remembered the garden. She remembered that a dip only becomes a real loss if you panic and pull everything out, so she left it alone. And a few months later, when the market recovered and then pushed past where it had started, she watched that same $500 have grown into something meaningfully larger, not because she'd done anything active in the meantime, but because she had simply let the asset do the job an asset is supposed to do. What changed for Sarah after that wasn't just her account balance. It was her entire mental framework around money. She started to see every dollar differently. Instead of asking herself, how much of this can I avoid spending? She began asking, what job could this dollar be doing for me instead? She began to think of surplus money, not as currency waiting to be spent on something, but almost like a small soldier that could be sent out to work on her behalf, showing up for duty every single day, compounding quietly in the background while she lived her actual life. That's the mindset shift underneath everything in this story. It's not about becoming obsessed with money or turning every purchase into an agonizing calculation. It's about recognizing that money has 2 very different jobs it can do for you. It can sit and wait, or it can go to work and multiply. Both jobs matter. You need some money sitting and waiting, an emergency cushion, funds for near-term needs. But the mistake Sarah made for 5 years was assuming that was the only job money could do. If you're watching this and you have money sitting somewhere earning next to nothing, money you won't need for the next several years, ask yourself the same question Priya asked Sarah. What is this money actually doing for me right now? Is it working, or is it just waiting? Because there is a version of your future, not a guaranteed one. Nothing in investing is ever guaranteed, but a genuinely possible one, where a decision this small, moving even a modest amount from a place where it sits still to a place where it can grow, compounds over years into something that looks, in hindsight, like the moment everything started to shift. There's one more piece of Sarah's framework worth sharing in detail, because it's the part viewers ask about most whenever she tells this story to friends now. How she actually decided where that first $500 would go, practically speaking. She didn't try to pick the next big winning company. She didn't watch financial news channels shouting about hot tips or chase whatever had gone viral that week. Instead, she followed 3 simple filters, and you can borrow them for your own first move if you want a place to start. First, she asked whether the investment was broad rather than narrow, favoring something that spread her money across many companies instead of gambling on one. Second, she asked whether the costs involved, the fees charged simply for holding the investment, were low, because even a small annual fee compounds against you, the same way growth compounds for you, quietly eating into returns year after year if you're not paying attention. Third, she asked whether she would still be comfortable owning this investment if she couldn't check its price for the next 5 years, a simple gut check that filtered out anything that felt more like a bet than a long-term decision. Those 3 filters took her all of an evening to apply, and they turned an intimidating, jargon-filled decision into something manageable enough to actually act on instead of endlessly researching. It's worth naming too what Sarah did not do, because avoiding certain traps mattered just as much as taking the right actions. She didn't take on debt to invest more aggressively than she could afford. She didn't move her entire emergency fund into the market, leaving herself exposed if her car broke down or she faced an unexpected expense. She didn't check her account balance every single day, a habit that research on investor behavior consistently shows leads to more panic-driven, poorly timed decisions, not better ones. She built a floor first, her safety net, and only then allowed herself to build upward from it. That order matters. Growth without a foundation is just risk wearing a more exciting costume. Sarah still saves. That part of her never went away, and it shouldn't, because a solid emergency fund is the foundation that makes it safe to take on the small, measured risks of investing in the first place. But saving is no longer the whole strategy. It's the floor she stands on, not the ceiling she's aiming for. The ceiling, the actual wealth building, comes from that second habit she picked up at 3 a.m. after a conversation with a coworker who was ordinary in every way except one. She understood the difference between storing money and growing it, and she was generous enough to share that understanding with someone who was ready to hear it. So here's the lesson, distilled down to what actually matters. Saving protects what you have. Investing grows what you have. The rule of 72 tells you how long your money takes to double at any given rate of return, and it reveals, often uncomfortably, just how slow that process is inside a typical savings account compared to a diversified investment. Depreciating assets lose value the moment you own them. Income-generating assets can grow in value or produce income while you go about your life. Diversification protects you from the danger of putting everything into one basket, smoothing out the inevitable ups and downs of the market. And the fear of those ups and downs, the loss aversion that keeps so many people frozen at the edge of their first investment, is real. But it's manageable once you understand that temporary dips are simply the cost of admission for long-term growth, not evidence that something has gone wrong. You don't need thousands of dollars to begin. Sarah started with $500. You don't need a finance degree, insider information, or a lucky tip from a stranger online. You need a decision. The same decision Sarah made at 3 a.m. with tired eyes and a racing heart, to stop only refrigerating your money and to finally plant some of it instead. If Sarah's story reminded you of your own kitchen table, your own quiet moment of frustration, staring at a number that isn't moving the way you hoped it would, know that the moment doesn't have to end in defeat. It can be the same moment that starts everything else. Thank you, genuinely, for spending this time with me and with Sarah's story. If it gave you even one new way of looking at your own money, that means more than you know.